There's a pattern in the economy, a rhythm, a pulse, a cycle that repeats over and over again. Most people never notice it. Politicians deny it, investors misread it, and ordinary families feel the impact only when it's too late. But the truth is simple: recessions don't randomly appear, they follow a cycle that has predicted nearly every major economic downturn in modern history. Today, we're going to break down that cycle, uncover how it works, and reveal what it says about the next recession, what's coming, why it's coming, and how to position yourself ahead of it. This is Mind Over Markets, where clarity meets a changing economy. The economy doesn't move in a straight line, it moves in waves: growth, peak, slowdown, recession, recovery, repeat. This four-phase cycle has existed for centuries, but what's changed is how fast the cycle moves and how dramatically it impacts the middle class. To understand what's coming next, we need to understand how these cycles form and why they matter. Phase 1: Expansion. This is when the economy grows, businesses hire, consumers spend, and confidence rises. This is the good times phase. Phase 2: Peak. This is when the economy hits its highest point. Prices rise, wages rise, competition heats up, and asset prices inflate. Everything feels strong, but beneath the surface, the pressure builds. Phase 3: Slowdown. In this phase, growth starts to weaken, consumers cut back, layoffs begin, borrowing slows, and debt becomes heavier. This is the warning stage. Phase 4: Recession. In Phase 4, the economy contracts, companies fail, markets fall, unemployment rises, and confidence collapses. Then the cycle resets. This cycle is predictable, measurable, and deeply tied to human behavior: fear, greed, confidence, and risk. Economic cycles aren't caused by one event, they are caused by behavior. People borrow too much during expansions. Debt fuels growth until it becomes unpayable. People spend too much at the peak. Confidence blinds judgment. People panic during slowdowns. They cut spending, hoard savings, and delay investment. People overcorrect during recessions. They sell low, avoid risk, and fear the future. Economic cycles are the collective psychology of millions of people. But one hidden factor accelerates the cycle more than anything else: interest rates. They control borrowing, spending, investing, saving, debt burden, business expansion, and housing market strength. Interest rates are the engine of the economic cycle. Today's cycle is being shaped by the fastest rate hikes in 40 years. This matters more than anything else for predicting the next recession. To understand the next recession, we need to see where we stand right now. Spoiler, we're not in recession yet, but we're deep into the slowdown phase, approaching a turning point. Let's break it down. 1. Consumer spending is weakening. High prices, high interest rates, high debt. People are spending less on restaurants, travel, durable goods, cars, and electronics, but are spending more on rent, groceries, utilities, and insurance. This shift is a classic slowdown indicator. 2. Business investments are falling. Companies are cutting hiring, expansion plans, and capital investment. And when businesses slow down first, a recession follows. 3. Layoffs are increasing, especially in tech, finance, retail, logistics, and manufacturing. Layoffs are a lagging indicator, but we're already seeing early cracks. 4. Consumer debt is surging. Credit card interest is over 20%. Auto loans are at all-time highs, and delinquencies are rising across the board. This is a warning sign. Consumers cannot sustain the current cost of living. 5. The housing market is stalling. Not crashing, stalling. Buyers can't afford homes. Sellers don't want to lower prices. This creates a freeze, and a frozen housing market often precedes economic downturns. 6. Corporate profits are shrinking. When profits fall, businesses cut back hard. This slows the economy further. Every major indicator says the same thing. We are deep in phase 3, the slowdown. And historically, this phase always leads to recession. Always. Let's break down how a recession actually takes shape. Not through panic, but through predictable steps. Step 1: Consumer exhaustion. People run out of excess savings, debt becomes overwhelming, and spending declines. This is happening right now. Step 2: Business retrenchment. Companies cut hiring, then jobs. They protect profits by reducing operations. This has started quietly. Step 3: Financial stress. Spreads, defaults rise, credit cards, auto loans, mortgages, and business loans. This weakens the banking sector. We are entering this phase. Step 4: Confidence collapses. People stop big purchases, businesses stop big projects, and investors flee risky assets. This is the emotional heart of recession. Step 5: Economic contraction. GDP declines, markets fall, unemployment rises, recession becomes official. We are not here yet, but we are moving toward it. Economic cycles have their own gravity. Once they start moving, the outcome is difficult to stop. What makes this next recession different? Every recession has a defining feature. 2001, tech bubble; 2008, housing crash; 2020, pandemic shock. But the next recession will not be driven by crisis. It will be driven by structural pressure. Here's what makes this one different. 1. High interest rates are here to stay. Even if the Fed cuts rates, they won't return to zero. Cheap money is gone. Leverage is gone. Speculative booms are harder. This slows everything. 2. Consumers are out of ammo. In past recessions, people had higher savings, lower debt, and more income flexibility. Not this time. Consumers are stretched thin before the downturn begins. 3. Governments are deep in debt. Stimulus will be harder. Bailouts will be limited, and tax increases are more likely. Governments have fewer tools. 4. Geopolitics are fragmented. Supply chains, energy markets, trade flows all remain unstable. An economic shock can happen anytime. 5. Technology is reshaping jobs. Mid-cycle. AI is automating middle-class work during the slowdown. This accelerates unemployment risk. 6. Housing is unaffordable and frozen. A frozen market is more dangerous than a falling one. Prices aren't moving. Sellers won't cut. This means buyers can't buy. This traps the entire economy. When you combine all indicators, we can map out recession probability. Current position: we are in the late slowdown phase, not yet recession, but dangerously close. Think of the economy like a bridge. The cracks are showing, the weight is increasing, and the support beams are shaking. But the structure hasn't collapsed. Yet. And based on historical patterns, the next recession window is 12 to 24 months, with rising pressure as global conditions worsen. But recessions don't follow calendars, they follow cycles, and all signals point in the same direction. Recession is not the end of wealth, it's the beginning of wealth for those who are prepared. Here's why. 1. Asset prices. Fall, stocks, real estate, businesses, land. Recessions reset valuations. The wealthy accumulate when others panic. 2. Competition shrinks, weak businesses fail, strong ones grow. Recession weeds out inefficiency. 3. Talent becomes affordable. Businesses can hire skilled workers more easily. 4. Innovation accelerates. Some of the biggest companies today, Uber, Airbnb, Facebook, grew during downturns. 5. Savings become powerful. High interest rates reward savers and punish debtors. Cash becomes opportunity. 6. Long-term investors. Win. Buying during downturns produces the strongest returns over 10 to 20 years. You don't prepare for recession during the recession. You prepare before. Here's your blueprint. Step 1. Strengthen your financial base. Build 3 to 6 months of savings. Reduce high-interest debt and avoid major unnecessary expenses. A recession strikes the unprepared first. Step 2. Level up skills that survive recessions. Focus on skills in econ, data, analysis, finance, AI, digital work, and online business. These skills protect income. Step 3. Create multiple income streams. Start with one additional stream: freelance, remote consulting, content creation, side business, and digital services. Income diversification equals recession insurance. Step 4. Invest consistently, not all at once, not emotionally. Slow, steady accumulation. Downturns build wealth. Step 5. Watch the job market. Pay attention to layoffs, hiring freezes, and wage slowdowns. These signals appear before recessions become official. Step 6. Position for opportunity. When the recession comes, assets get cheaper, businesses become available, competitors vanish, and markets reset. This is where long term wealth is created. Economic cycles are not random, they follow patterns shaped by human behavior, policy decisions, and financial pressure. Right now, we are deep in a slowdown, moving toward a recession that will shape the next decade. But the goal isn't to fear it, it's to understand it, prepare for it, and use it. Recessions don't just destroy wealth, they redistribute it. The question is, will you be on the losing side or the opportunity side? This is Mind Over Markets, where clarity meets a changing economy. Stay focused, stay informed, and stay ahead.